Hi guys, welcome to my videos. So guys, with the rising interest rate and rising inflation, things are definitely not going good in Canada, at least till the middle class people. And lot of people are worrying about their trigger point of their mortgage. So today in this video, we are going to discuss about what is this trigger. Like actually it's a combination of two triggers and that we are going to discuss. And this is for the people, those who have variable rate of mortgage. So before I proceed further, if you have not already subscribed to my channel, then what are you doing? Go ahead and hit the subscribe button. So let's proceed, guys. Again, I would like to clarify I'm not a financial consultant. So this is just based on my regular research and analysis. And if you take anything out of this video, you do it at your own risk. All right, guys. So guys, we know that in Canada and in most of the places, we get two kinds of mortgages, fixed rate and variable. So with a fixed rate mortgage for a term, your rate is locked. So whatever the authority does with the interest rate, for example, you see that Bank of Canada has increased interest rate 8 times since last February. That's not going to impact you until the end of your term. So till then your interest is locked. It cannot be increased. Fine. Next is variable rate. This is where the actual game starts. So with variable rate, there are two kinds. One is like fixed payment, another one is like variable payment. So with the fixed payment, what it does, like out of your payment, a certain portion goes towards your principal and a portion goes towards your interest. If rate of interest increases, okay, what's gonna happen? More and more portion of your payment is gonna go towards your interest and rest principal. And if on the other hand, if rate of interest decreases, more and more principal your amount is gonna cover. All right, now because interest rates have recently increased a lot, so that is where these triggers are coming into the place. So the very first point is like what is trigger rate, and then what is trigger point. So trigger rate is at a rate when your mortgage payment, okay, for under variable is only covering the interest and not the principal. So what it is gonna do, then your principal is not decreasing, the principal you owe is not decreasing, right? So whatever you make, let's say you pay $1,000, so that means $1,000 is going towards your interest. And if your and if it is still not covering all the interest you owe, like if you are on the fixed payment, then what's going to happen, like it will uh, increase the amount you owe, because any interest that you are not paying is going to be added to the amount you owe, and you'll be paying more interest down the line. So it will this will be like negative amortization, because you are not amortizing anymore. It's negative amortization, your debt is increasing. So this is where the situation goes bad. And then what is the trigger point? So we discussed trigger rate. What's trigger point? So trigger point is a rate when you reach that where you can no longer carry on with the same monthly payment, because for example, let's say you took a mortgage of 400,000, okay, and you were paying, and you managed to pay down 10,000 as principal, and right now you owe 390. Then after interest rate fluctuation, you reach the trigger rate, and then you again start owing interest back to your principal. And then what happens, like right now you reached 400, bam, I mean whatever you owe you reached. So at this at this point, what's going to happen, like even if you keep on paying money, you are never going to pay your uh, mortgage back, right? So at this time, this is called trigger point. Again, there are other criteria too, but this is how it goes initially. So at this time, definitely, like your lender will give you a call through your mortgage broker or whatever, and they will present you few options, like either you increase your monthly payment so that you cover more, or you make some lump sum payment so that you decrease the principal you owe, because anything you pay lump sum goes towards your principal, right? Third option they may give you is like to go towards fixed rate, but again there could be some penalties associated. So that is always the case. So that's how it works, guys. So I hope I was clear. If I was not, please let me know. Thanks for watching this. Please subscribe to the channel.